Good morning, everyone. You are watching a live daily market outlook from Windsor Brokers for Tuesday, 5th of February 2013. The main characteristic of the past 24 hours trading is return of the risk-off mode as single currency eases lower and takes some important supports. Sterling remains under pressure. Dollar yen eases down to significant support at 92.00, while dollar Swiss runs out of steam on its corrective action somewhere around 91.20, showing a lack of momentum for some stronger recovery. The gold benefits out of this, as well as dollar jumping higher, but still holding a overall negative tone, as some important levels on the upside are still intact. Crude oil eases significantly following a pullback of 98.22, dips down to 95.90. We are testing basically the 96 support that is important ahead of key supports at 95.50 and 95.00, with more pressure seen at the beginning of the day towards the downside. As said, the extension of the euro's weakness on yesterday and during the overnight session is political uncertainty in Italy and Spain that prompted traders to take profits on the single currencies. Strong gains so far this year during the month of January, where the single currency peaked yesterday at 137.10, prompting investors to take profit and pushing the single currency significantly lower against the US dollar. This also helped to ease selling pressure on yen against the euro and lifting it above 33-month low against the dollar, though entrenched expectations of more monetary easing in Japan kept the Japanese currency still in check. The negative and the bad news that brought again black clouds above the markets are coming from Europe and Italy and Spain, basically as government bonds and stocks, I do apologize, sell-off were sold on Monday amid growing political uncertainty in the two countries. That also poured the cold water on the initial optimism that Europe is on the footpath towards recovery and slowly healing from its debt crisis. Spanish Prime Minister Mariano Rajoy faced calls to resign over a corruption scandal, while in Italy, growing popularity of former Premier Silvio Berlusconi was a worry for investors in the run-up to elections this month. We're going to take a look in the technicals just briefly to see today's calendar. These were the highlights of the day, with the releases seen for today. During the overnight session, we had the interest rate decision from Central Bank of Australia that, as expected, kept the interest rates at 3%, with the reaction of the markets, sharp fall of the Aussie dollar against the US dollar from approximately 104.50 to approximately 0400, with the quick recovery seen afterwards. The trade balance from Switzerland released early this morning showed the narrowing the trading surplus from 2.9 billion Swiss francs in month of November to only 1 billion in the month of December, and the forecast was at 2.74 billion Swiss franc. The services PMIs from Italy, Spain and the Eurozone are due at 8:15, 8:45 and 9:00 GMT respectively. Spanish one comes first. 44.7 has already been released. We're going to take a look. Our calendar hasn't been updated yet. We're going to take a look on the release of the Spanish services PMI for January. It was forecasted at 44.7 with the previous release at 44.3, with the release at 47.7. 0.0, much better than expected. There's still to come is Italian one that is again forecasted slightly better, 45.9 compared to 45.6, while Eurozone's January's final services PMI seen no change in January compared to December, 48.3. Another one comes from UK at 9:30 GMT, 49.8 improvement in January seen according to the forecast compared to 48.9 is in the month of December 2012. All of them are still well below the 50 break point and still showing that the economies in these countries are contracting. 10 o'clock GMT, we have retail sales from Eurozone December release. Further the decline in the retail sales seen in December, minus 0.5% compared to the growth of 0.1% in the November 2012. And then another significant is ISM non-manufacturing PMI from United States for January, due at 1500 GMT. 55.2 is today's forecast, compared to 56.1 in December 2012, slightly below the previous release, but holding above 50 breakpoint, shows that U.S. economy is showing initial signals of recovery. And that's basically all from news and fundamentals. I suggest we move now to the technicals and see the latest movements and the expectations for the coming sessions for the major currencies and the commodities. The euro is bouncing higher at the beginning of European session after testing levels below important support, that is 134.85. This is the initial support zone, 135.00, 134.85. Also the previous highs of 28 and I do apologize, 28 of January. And this also marks approximately 76.4% retracement of the rally from 134.13 to 137.10, and also it's approximately 50% of a larger rally from 132.64 to 137.10. Double Fibonacci support and the 55 days exponential moving average accompanied with the previous highs give a good support, and basically this is seen as the near-term breakpoint. So far there was a crack of this level down to 134.58 that shows the downside is still vulnerable, and the single currency could travel lower on its recent sell-off that commenced last Friday, from 137.10 fresh high that was posted last Friday, and retracing now over 50% of the initial rally from 132.64 higher base to 137.10. As said, a prevailing negative tone on the near-term studies. As we can see, the hourlies are well in the negative territory now. The indicators are reversing. RSI is emerging above the out of the oversold territory as the direct result of a current move higher, and we have to see the levels that will be significant on the upside, as obviously we are in the near-term corrective action, approximately 135.20. Yes, we just regained the psychological 135.00, 135.20. Around there is the initial resistance, descending 20 days exponential moving average hourly one, and the 23.6 of the latest down leg wire. More significant level comes at 135.50, 60 zone, where we have the 55 days exponential moving average and the 38.2% Fibonacci retracement. And at this point, break above this level would be a signal for some stronger recovery and would avert immediate downside risk. Open upside to 135.84, 50%, and 136 as psychological resistance. From the other side, 4-hour indicators are just sliding into the negative territory, though some reversal is now seen on the RSI, and the stochastic still no clear signal of stronger corrective action. And as said, we need to see break above minimum 135.50, 60 in order to signal some stronger recovery. Otherwise, risk remains towards the downside, as basically screaming indicators on the larger picture that are already pointing lower on the daily chart, a signal that some stronger corrective action is cannot be ruled out following the strong rally of the single currency from July 2012 from 120.42. That has so far been unobstructed and regained the levels at 137 so far. This was the last Friday's peak. So basically the corrective action sees the good barrier at 135, 50, 60 zone, and if we see the break above here, then would be a signal for that will avert immediate downside risk, and probably to try higher break above 136, 136.14, where is 61.8% retracement is to bring the pair in the more safe territory in the near-term action and avert immediate downside risk. Otherwise, a scenario of a lower top and fresh extension higher also cannot be ruled out. As we said, the negative tone that is now establishing on the 4-hour charts does not rule out a stronger pullback. On the downside, break below recent lows opens immediate Fibonacci support 38.2% at 134.37. We're talking about rally from 129.96 to 137.10, accompanied with the previous consolidation range tops at approximately 134.00, and this violation of these levels could be a trigger and signal for some stronger recovery, of course, stronger correction. Of course, confirmation comes on a break below 50% at 133.53, 50% retracement of 129.96 to 137.10 rally, pardon. As said, upside 135.50, 60, 135.85 break above to ease the current bear pressure, though the more likely scenario would still seen as a lower top and fresh weakness, but the buyer seems to be finding good ground on this, and some comments said that good offers were parked around the 135.85 zone. This is seen as a trigger for this, with some stops being collected most likely at 135. That accelerated the recovery rally, but still a lot of work to be seen towards the upside if we want to signal that bulls are back in play. Otherwise, still a possibility of further weakness cannot be ruled out. British pound against the US dollar failed. Initially, the recovery failed at approximately 157.70. This is between 38 and 50% retracement, and generally the recovery rally from a recent low at 156.84 was limited on approach to 50% retracement at 157.81, and generally was capped by descending 55 days exponential moving average. A fresh weakness found support at 157.26, and now we have a fresh rally higher. The hourly studies are still neutral at this point, as long as 157.70, 157.80 stays intact, while 4-hour structure is negative with the 20 days exponential moving average so far capping the upside ahead of another one at 55 days at approximately 158 zone. If we see a break above this, then that will be further signal of basing, near-term basing, as the pair dipped twice to 156.73 and the 156.84, and basically it's currently consolidating recent losses, as initial basing attempt failed at 158.73, and the subsequent weakness brought the price lower. Underlying bearish trend is still fully in play, and the current movements are just seen as consolidation. Unless we see break above 158.77, 159, that will confirm the double top pattern, and there will be signal for some stronger recovery. Most likely scenario would be further range above these recent lows ahead of a fresh extension of the broader downtrend that commenced from 163.80 peak of 2nd of January 2013, and would likely open levels 156.34 and 156.00 on a break. As said, on the upside, immediate barrier 157.70, 157.80, and then 158 level psychological, and 61.8% retracement of the down leg from 158.77 to 156.84, again, which to ease immediate bear pressure, and though the price will still hold within the recent range, only break above the range top at 158.77. And regain of 200 days moving average currently at 158.87 would be a good signal for some stronger recovery. Otherwise, further consolidation would likely precede the fresh weakness through 156.84.73 recent base and open way for extension down towards 156 zone. The dollar yen is in the corrective mode of 93.17 peak posted, fresh peak posted yesterday, with the 92 zone as initial support seen tested so far. This marks approximately 50%, basically exactly 50% of the up leg from 90.73 to 93.17, pardon, and I do apologize. In yesterday's written analysis, I mentioned that a loss of 92.50 would open way towards 92.00 as strong support that basically occurred. Support was found at this point for now, whereas also ascending 20 days exponential moving average that so far contained dips, and ideally this should be seen as a reversal point, though break above 92.55 recent recovery peak of overnight's basically session high is required to confirm the near-term basing attempt and shift focus again up towards 93 and 93.17. Underlying bull trend is still in play despite extremely overextended conditions on the daily chart, and yet not showing any signals of reversal, while descending 4-hour indicators coming out of the overbought territory are still pointing lower and still see room for some stronger corrective action. A break below initial support at 92.00 is expected to open 91.40, 91.23 previous highs, as well as 38. This is quite significant support, 38.2% retracement of the upleg from 88.05 to 93.17, reinforced by ascending for our 55 days exponential moving average, and the break below this level, I would say, would be quite harmful for the near-term bulls, as this will confirm the near-term top at 93.17 and allow for some stronger corrective action. For now, as long as we are holding above 92, a possibility of stronger bounce higher is quite likely. We need to see break above approximately 92.50.60 in order to confirm basing attempt, and possibly to refocus upper boundaries 92.95 and 93.17. Dollar Swiss is still in the consolidative mode of recent low at 90.20, with the 91.20 zone so far capping the upside attempts. This marks approximately 50%, near 50% of the down leg from 92.25 to 90.20, where the congestion now is evident. Several attempts higher so far being capped, as the hourly structure is slightly positive but lacking momentum for any more significant move higher, while our 4-hour indicators are pointing higher, still in the negative territory, and require a stronger bounce higher in order to confirm recovery. We need to see the break of initial 91.20 and then 91.50 that marks 61.8% retracement, along with the 91.63 55 days exponential moving average, in order to pick up recovery and avert immediate downside risk of slide through 90.20, 90.00. That would open way for further extension of the larger downtrend from 93.87. This is the descent from latest downleg from January 18th of January 2013, and the part of a larger downtrend from 2012 high at 99.70 posted in July 2013. That will open way down towards 89.30 and 89.00 on a break. we're going to take a look at yellow metal. Basically, the price action in the near term is still entrenched within the range, and the rather neutral tone is seen as long as the price holds between 1657 approximately at the downside and 1680 on the upside, with the near-term tone slightly aligned towards the upside following yesterday's rally from 1661 up to 1677, still lacking strength for a test of recent peaks. Last Friday spike high at 1682 and the high of 30th of January at 1683. That limits the current sideways, I would say, range trading. A break above these levels would be a signal for some stronger recovery. It will be a signal for extension of the recovery rally from 1652 low of 28th of January 2013. As we can see, the upper Bollinger 20 days Bollinger Band is so far limiting the upside, but the upper boundaries are in the near-term focus as 4-hour indicators slightly move into the positive territory, but still holding, I would say, rather neutral tone at this point. And basically, not to elaborate much about this, a break of either side of the current range would be a signaling, would signal the near-term direction. On the downside, we have around 1660, on the upside around 1680 to define the fresh direction of the yellow metal, but still a negative, rather negative tone still seen on the on the daily chart, despite of course close and bounce above 200 days moving average still needs work on the upside, 1680 as we said, and then 1697, which are the previous peaks and the trendline resistance required to confirm the near-term base at 1625.35 zone and allow for some stronger recovery. From Ichimoku studies, a daily cloud base at 1681, which coincides with the current recent peaks, is offering quite good resistance, and this is basically capping for now the upside attempts. Penetration of these levels is seen as supportive as the price moves above the Tenkan-sen line that is currently at 1668 and holding above Kijun-sen line at 1661. That offers support on the lower boundaries of the range. According to the Ichimoku studies, the positive tone, initial positive signal is given, but still penetration through the cloud base at 1681 and probably emerging above at 1694. That again coincides with the previous stops, and trendline resistance is required to improve the near-term structure and signal stronger recovery. Otherwise, the downside will remain vulnerable, and as we said, break on either side of the current ranges to define the near-term direction for the yellow metal. And finally, the crude oil extended its near-term corrective action of 98.22 high of 30th of January down to 95.88, testing support at 96.00, with the 4-hour structure now being in the negative territory. We need to see a regain of levels on the upside. If we see the Fibonacci levels first, 96.44 is the initial one. More significant is approximately 96.7080, where we have the 38.2% retracement and the 55 days exponential moving average to avert the immediate downside risk of retesting very strong support at 95.50 and 95.00, loss of which to signal a stronger corrective action as the crude oil remains in an obstructed uptrend since 11th of December 2012, a rally from a higher low at 85.20 that so far did not show any stronger corrective action. Now, initial signal was given on a break below 96.90 and denting 96.00, but still as long as 95.50, 95.00 holds the downside, the upside remains in focus as the dailies are still positive, though quite extended. Still see potential for a fresh stretch towards $100 per barrel, and current movement towards the downside. This could be still described only as corrective. We have to keep an eye on the downside at 96 as initial and 95.50, 95.00 on the upside. We set the initial one is 96.50 and then more significant 96.80, while the break above 97 would ease the immediate bear pressure and probably will signal return towards the upper boundaries where we have 98.00 and then 98.12, 98.22. Also, the important barriers at this point are seen. We just need to find this chart above 98.22. We have the upside is quite well protected. The 98.22 is the recent high. Then we have 98.27, high of August 2012, and the 98.54 is the Fibonacci 61.8% expansion of the wave from 84.05 low of 7th of November 2012. Clearance of these levels is to prompt fresh extension higher and probably to focus $100. And on the downside, as we said, 96 and the 95.50, 95.00 seen as a break points to allow some stronger corrective action. That's all from me. I think I spoke enough. Guys, now it's your turn. Do you have any questions, any suggestions, any comments? Please, you can submit them now. Euro yen, it's been some time to take a look at this. Let me just find it. Okay, the bearish tone dominates on the lower time frames of the ADX. The bears are still in control following a pullback from 126.95, a recent peak posted last Friday, with the low so far seen at 124.00. Now, if we take a look at the larger picture, basically we have to go to the monthly one to see that strong rally from recent low at 94.10. July's low at 94.10 has retraced nearly 76.4% of the longer term descent, 139.21 to 94.10, with the strong bullish stance still seen on the lower, on the larger time frames, although the overextended conditions on the weekly and the daily are initial signal for some more significant corrective action. Ichimoku studies show hourly's the hourly cloud base at 124.96 now offers initial resistance for the current recovery from 124.00. 4-hour Ichimokus are still firmly positive, as well as daily ones. Now let's take a look at the daily structure. We said overextended conditions. No yet clear signal of reversal, but a suggestion for some stronger easing exists. Now the descending 4-hour indicates from the recent top at 126.95 signal that corrective action could extend lower below 124.00 as the 123.6 has been percent retracement has been so far reversed, with the more significant support seen at 123.16, where we have the 38.2% retracement of the uplift from 117.03 to 126.95, reinforced by ascending 55 days exponential moving average. Ahead of this is 123.83 that has already been tested approximately. These are the previous highs of end of January. So 123.16, 123.00 is seen as the next significant support. Still descending indicators on the 4-hour chart, though there's some reversal seen on the RSI and the stochastic, yet no firm signal of reversal. Still keeps the downside more vulnerable. Also, the hourlies are in the negative territory, though the break above 20 and now attempted 55 days exponential moving average is giving initial signal. Basically, we need to see a break approximately 125.50, 125.80 in order to shift focus higher and the signal higher low That's currently at 124.00. Otherwise, extension down towards levels, as we said, 123 zone could be quite a likely scenario in the near term. Of course, and a lot depends now on the performance, overall performance on euro, as some negative tones are coming from burning problems for the eurozone, Spain and Italy, and of course this is going to have a great impact on the currency. We have to see how the things will be developing in these two countries, and this is actually going to give the main tone for the movement of the single currency in the near term. Is there any other question, please? It seems no. In that case, there is a question. Euro is, pardon, going up and the traders buy it. Who is selling? Look, in this case, let's put the euro dollar as a good sample, where we can see it the best on the 4 hour. Overall, uptrend is still intact. Buying is pushing the price higher. Now, when the good number of sellers appears, basically when the sellers number of sellers goes above the number of buyers, let's put it the simplest way, and then of course the price starts descending. As I said, good offers, good bids were seen at 135, 134.85. That proved to be quite correct, but still sellers at this point, I would say, still dominating, unless we see the break above levels that we mentioned. I'm around 135.80, 136, where it will reach sort of equilibrium, and then anything above here will signal that the buyers are back in play and dominating, while any reversal there would be signal that current buying was just profit taking of the recent down move from 137.10, and this is basically is going to signal the negative sentiment of the euro dollar. Any reversal below previously mentioned the levels will signal that the sentiment is turning negative, and the investors are more into the selling euro, as they assume, and they, according to the technicals, quite extended conditions. I mentioned, I think I said screaming indicators look for some stronger corrective action, as it's in an obstructed rally since July 2012. The most significant correction we had from 131.67 to 126.60, and then since November 2011 there was a strong trend, just brief corrective actions. This requires some corrective action. So in case of the sentiment turning negative, in this case, that will show on a failure to break above 136, let's say, as a significant level. It means that the sellers are back into a game, and they see more potential towards the downside. So this is basically the pushing the price. If the number of sellers in this case is bigger than the number of buyers, the price will go lower. In this case, we have to watch the levels, as I mentioned, approximately 135.80, I think 136.00, approximately there, and that will be signal that the buyers are again taking control. Otherwise, as I say, usually fresh lower top and fresh slide lower would be likely scenario. So it means that sellers will remain in play, just taking profit of the initial rally, booking profit at a good support, approximately 134.80. There was slight dip lower, and then re-entering positions somewhere around these levels. In case of clear break above this, meaning that the sentiment is turning positive, and the bulls and buyers are back in play. I hope my answer was clear and satisfactory. Okay, thank you. If there is no questions, then we'll conclude today's session. Keep an eye on the markets, of course. I would like to invite you for tomorrow's session again at the same time at 8:00 GMT, 10 o'clock local Cyprus time. Again, wish you nice Tuesday, and of course profitable trades. Of course, keep with the trend no matter in what time frame. As long as you are with the trend, trend is your friend. Have a nice day and good luck.